Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset, and companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. But banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
According to Tom Lee, we're on the brink of a powerful bull run driven not by hype, but by economic math itself. According to Tom Lee, Bitcoin's value might triple while the S&P 500 reaches all-time highs. Why does it matter? Because AI-driven productivity increases are rewriting economic forecasts, liquidity is returning, and inflation is dropping. These are not arbitrary bullish calls for Lee. They are predicated on structural changes, such as a significant reallocation of capital into riskier assets, declining interest rates, and demographic tailwinds. He contends that the main gainer from this increase in liquidity will be Bitcoin. Bitcoin's finite quantity and increasing incorporation into global banking make it more than just an alternative asset, it's a necessity as institutional investors seek returns. And here's the twist. While the mainstream media obsesses over daily volatility, Tom Lee sees Bitcoin's path to six figures as almost inevitable within this macro setup. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
Basically, the question is, everything that Bitcoin maximalists have wanted to happen has happened. It's now being traded by mainstream financial institutions. So why does it have an opportunity to go up from here?
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000, 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset, and companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. But banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's not public.
How do you trust those Tether people? Like you don't really know what's going on.
Well, that's where, see, this is where blockchain comes in, that blockchain has proven you don't need to know the counterparty. You just have to trust the code. Mm-hmm. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world. So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you again model this out and utility, because remember, stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does in fact want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
Tom Lee's views on Bitcoin and stablecoins go far beyond simple cryptocurrency trading. He is outlining a comprehensive overhaul of the global money system. According to him, stablecoins are becoming into useful alternatives to some aspects of the financial system, transferring cash instantaneously and eliminating the need for middlemen. They are not just dangerous tokens for speculators. In the meantime, Bitcoin serves as this new digital financial network's backbone and safe settlement layer. You must comprehend how this new digital system interacts with old finance, particularly in times of market stress, to appreciate why this is so important. Theory and hype aren't the only foundations of Lee's research. To determine what is actually influencing the markets, he employs actual data and thorough risk analysis. Lee concentrates on what truly verifies serious trouble when uncertainty rises, whether it is due to geopolitical tensions, Federal Reserve policies, or recessionary fears. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
It's a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck, in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail. Statistically, it's still going to stay at 90% for accumulated history. So like it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And, like, for us this year, it was the high-yield market because high-yield spreads need to widen to, like, 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%. Whereas the economists were saying it was 60, and we could tell by positioning and what stocks were selling off. The S&P down 25% has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. We do have a published history of our research, so our clients can fact check us. But
Okay.
As the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And of course, everyone argued against it for logical reasons. They said, tariffs, they're not going to be solved for a year. The Fed's not your friend. The Fed is going to, there's no liquidity coming like in 2020. So you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce.
According to Tom Lee, his team's market projections are supported by data and sensitivity research rather than merely conjecture. Even if something has an 80% or 90% chance of happening, there is still a risk that it will fail occasionally. They use data to create high probability statements. An event with a 90% chance of happening, for instance, may fail 3 times in a row, but statistically, it will always have a 90% chance of happening. He was questioned about how he can make 80% sure predictions about things like the S&P 500 jumping. According to Lee, surprises frequently lead to significant market movements. For example, Tesla's stock surprisingly surged today. Market value is generally anchored by things like profitability or the Fed's dovish posture, but it can also be weighed down by negative factors like tariffs or recession fears. In order to measure actual economic stress, Lee's team focuses on credit markets, particularly high-yield bond spreads. High-yield spreads only increased by roughly between 100 and 200 basis points throughout the trade tensions, despite experts' warning of a 60% likelihood of recession. Spreads would need to increase by 800 basis points over treasuries in order to indicate a real recession. This informed him that there was no real recession in the market, only a growth panic. Despite a decrease of 25% in the S&P 500, high-yield spreads indicated that the chance of a recession was only about 10%. He maintained his positive outlook throughout the April lows because of that discrepancy. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.